What is up, Iron Condor fans? This is the Mighty Eagle coming at you with another trading video, actually the first one of this channel. Hopefully I can do a few more here as the spirit moves me. This particular strategy is going to be using the Fibonacci Retracement as well as E-Trade brokerage and the quote trigger orders. So I'm going to teach you how to do both. So first off, let's go over the Fibonacci retracement. So basically what you're going to want to do is, for example, in TradingView, you're going to want to click the Fibonacci retracement element. You're going to be drawing it from the high to the low. So we've got a low here of 180.17, 189.46. You're also going to want to incorporate some minor support and resistance levels, which is going to be 60% of the next highest Fibonacci level. So for example, 1.618, 60% of that's 1.25. So you're going to go into settings, going to go into style. You're going to calculate out what 60% of the higher level is and add that as a new line. Now I like to use the same colors as the major lines, just with about 50% opacity, so I can know that they're minor lines. Additionally, you want to go into style and make sure that you extend the lines all the way to the right, and that you put the labels to the right as well. Now we do this because if you're looking at a chart, candlestick chart, a lot easier to see the numbers on the right side of the screen, especially where, price is populated. You can basically see everything pretty clearly, unlike if they're at the left or the center. So that's the way I prefer to use it. Now, how do we get an entry here? Well, we're just going to look for movement with increasing buying volume over a major level. So for example, I was looking at this after an alert on our local Discord, which I'll maybe possibly share with permission, at about 10:20 or so. Saw it and then started looking for an entry. I looked at it. I saw it sort of push up with some increasing buying volume, especially as it went over, gapped up over the 0.786 level, which you can see here. See if I can draw something on here. 0.786 level. That's a crappy arrow. Anyways, see if I can actually get a actual arrow here. Make it look a little more presentable. All right, so basically about right here. Let's reverse that. There we go. And we'll make that red. So basically about here, I was looking at entering as it crossed over. We had some sort of increasing selling volume, on the 5 minute. Whenever I'm going for an entry, especially for the day trade, I look at the 5 minute. But I liked how it crossed over. And it sort of found some support there at that 0.786 level, so I bought in. I set my stop, as it were. Let me actually favorite that, so I'm not having to go back in. Stop, as it were, at about 1.8658 or so. A little bit less than that. Sometimes the stop loss algorithms will get you, unless you put it just a little bit beyond that, but usually it's pretty safe. So anyway, so Now, as the price moves up, and you can see we had some great price action here, increasing volume, especially on this next tick after about 11 o'clock, which is always great to see. So that means there's a lot of buyers stepping in. Now, as it takes new major support levels, and remember these are the darker, 1.786, 1.68, the default Fibonacci levels. As it takes these new levels and remains above, gaps up, opens and closes above, you're going to keep moving the stop up. So for example here, as it crossed at about 11:15, I was looking to move my stop up, moved it up to this 0.87 level here at 188.2 or so. And then that was pretty much my stop. I played it aggressively because I was a little busy, so I didn't want to, sort of hang on to it and get distracted by it from what I was actually doing. So I actually got stopped out about here, 191.77 for about 50% profit. Only trading about one contract or so with this Mark Douglas strategy. Now, if I had kept with my strategy and wanted to keep it on, it was a weekly for next week, I could have done that. Absolutely. I would have kept it until it broke above near the end of the day. It broke above with some more volume above 195.18. At that point, I would have set a new stop, but then it's the end of the day. And basically, your trade orders and E-Trade that I use, they're called quote triggers. Basically, that's a way of insulating yourself from volatility and options prices. So it'll sell when the specific price of the underlying is reached, or buy, or market sell or market buy. Usually do a market sell. As I'm moving my stops up from these levels, just to insulate myself from any volatility in the price action. So you can actually set, your stop at 191.74, and when the underlying hits the price, it'll execute market sell for you. So yeah, this is a great strategy, especially if you use one contract, because you can keep taking profit on the way up, and get stopped out when you need to and stay in it when you need to. Obviously, there are times where you have an extremely volatile underlying, you'll get stopped out just a bit early. And that's why I say if you feel that, there's some extra volatility, definitely be more aggressive and you're moving your stops up, like I was in this trade where I got stopped out at 191.77. But if you want to hold on to it, if you have some time, absolutely do that. If you feel confident, the price is going to continue to move in your direction. That's how you would technically play this, is move it up once you see that you have some significant volume and it breaks above a new Fibonacci level. Please like and subscribe, and thanks for watching.